Well, 6 months into the Iran war, and the Organization of Petroleum Exporting Countries, or OPEC, now faces an unusual problem. Its ability to influence the oil market is weakened sharply. The alliance accounted for around 40% of global oil output in the month of July. That's down from more than 48% before the war. Its core group of 7 producers, including Saudi Arabia, Russia, Iraq, Kuwait, Kazakhstan, Algeria, and Oman, contributed about 25% of global output. The decline has reduced OPEC's ability to act as the world's swing producer, particularly as the war has disrupted production and exports across several member countries. The biggest constraint is the Strait of Hormuz. The blockade has restricted a crucial export route for Saudi Arabia, Iraq, Kuwait, and other producers since March. Now, OPEC has announced 6 oil output increases, but most have remained largely on paper because producers cannot easily move additional barrels through the disputed route. That is a major shift from the past. Now, when traders closely watched OPEC decisions because changes in production could quickly influence prices. Now, today the key question is not simply how much OPEC wants to produce, but how much oil it can actually produce and export. At the same time, China has emerged as a major force balancing the global oil market. Since the war began, Chinese crude purchases have fallen by roughly 400 million barrels compared with the same period last year. Lower refining activity, a ban on fuel exports, and the growing use of electric transport have all contributed to weaker demand. That decline has helped put a ceiling on oil prices, despite what analysts describe as the worst ever supply disruption. The shift marks a significant change in the oil market. OPEC once acted as the key swing producer, but China is increasingly becoming the swing demand center.